we are discussing ratio analysis in financial terms. Ratio analysis always means finding financial ratios. You can imagine this is very much similar to a doctor diagnosing a health of a patient, or even doing prognosis of a patient using numbers like blood pressure, glucose level, etc. Uh, trying to find out the health of a patient not just now but also in the future. Similarly, we can do ratio analysis to do diagnosis of a firm, to find out its current financial health as well as its health in the future. Depending upon what we are evaluating, the ratio analysis can be categorized into mainly 5 types. So these 5 types are short-term solvency, long-term solvency, asset management, profitability ratio, and market value ratio. First, we can measure short-term solvency or liquidity. That is, firm's ability to pay its short-term debts like within 1 year or maybe even shorter like 1 week. So the ratios are also called liquidity ratios. For example, we have current ratio, quick ratio, and cash ratio. You can note liability. For current ratio, we use everything in its current asset. For quick ratio, we only include those assets which can be easily converted into cash. That's why we exclude inventory from the current asset. For cash ratio, we only include cash because this is most liquid asset. And this ratio is very useful for very short-term creditors who quickly want to see how fast the firm is able to pay its bill. Second area, what we can measure is long-term solvency, also known as leverage. That is the firm's ability to pay its long-term debts. Examples here would be total debt ratio times interest on ratio, cash coverage ratio. Total debt ratio is simply like liability divided by assets. The similar ratios are debt equity ratio, equity multiplier. These three, the total debt ratio, debt equity ratio, and equity multiplier, essentially calculates the same thing. So you may find them, so we have to be aware of these. Other example for the leverage ratio would be times interest on ratio. And actually cash coverage ratio is also similar to times interest on ratio, except that depreciation is added in addition to interest and taxes. Third area, what we can measure is how efficiently the firm can utilize its assets. Remember the word utilize. That's why the ratios are also known as utilization ratios. Some good examples would be inventory turnover ratio, receivables turnover ratio, total assets turnover ratio. Okay. In case of inventory turnover ratio, we find how good we are in managing inventory. As long as we are not running out of stock and so foregoing sales, we will have a higher value of this ratio, meaning more efficient we are in managing our inventory. This can also be expressed in terms of days, and in that case, this is known as days sale in inventory. So inventory turnover ratio and days sale in inventory measures the same thing, except that they are in inverse relationship, and days sales in inventory expresses in terms of days, for a year. So that's why you'll see 365 in there. To measure how fast we collect sales, we use receivables turnover ratio. And also, this can be also expressed in terms of days, and that is known as days sales in receivables, also known as average collection period. Okay, some people may use the term average collection period instead of days sales in receivables, and we should remember that these means the same thing. Okay, and also the receivables turnover ratio and days sale in receivables also measures the same thing. These have inverse relationship. Okay, total assets turnover ratio or capital intensity ratio helps us measure how much sale is generated for a given asset. Capital intensity ratio directly tells us in dollar term how much of asset is required to generate $1 in sale. For example, if I generate $1 in sale and I use only 50 cents in assets, so it will give me the capital intensity ratio as 50. Okay, that's just 0.5. At a first look, it may look like lower the capital intensity ratio, better it is, right? So I'm only using 50 cents to generate $1 in sale. But we have to be very careful. For example, assets which I am using may be old. I may have an old equipment which I have depreciated. That's why my accounting number may show it as 50, because of depreciation. Fourth area where we use financial ratios is to measure profitability. That means how efficiently a firm manages its operation, and actually assets as well. And these includes very popular ratios such as profit margin, return on assets, return on equity. And look at all these ratios. They all uses net income number in their denominator. Net income number on their numerators, not denominators. It's very easy to remember. And moreover, these are the number from the financial statements. So the ratios here are also known as return on book ratios because the numbers are from the book. We do have ratios to measure the firm's market value, meaning its stock prices. Since we have stock prices only for publicly traded companies, the ratios used here are applicable to publicly traded companies only. Also, the ratios here are also very popular ratios such as price per earnings ratio, price per sales ratio, market to book ratio. So we saw several ratios in 5 broad categories. There are a few things we have to remember because same thing can be expressed in different ratios, like different people can use different names to express same thing. We have to be aware of what each ratio means. Moreover, people may even calculate in a different method, procedure, or process, we have to be aware of it, and we also have to document our method also.